Good morning, ladies and gentlemen. I would like to welcome you to the second day of the iFX EXPO Asia for the year 2015. My name is Erez Romas. I'm the COO of Forex Magnates, and we have another interesting and exciting day for you. We will start with the CEO's panel, in which we will discuss some of the major issues that influenced the entire Forex industry in the past few weeks. The panel will be moderated by our very own Adil Siddiqui, our institutional editor at Forex Magnates. I hope you enjoy. We will leave time for audience Q&A at the end of the session. Enjoy.
Thank you, Erez. Good morning, everybody. How is everyone doing today? Had a nice night with the party. I see a few smiley faces, a few hungover faces. So we get the show on the road. We're talking about the Swiss crisis, which I think affected a lot of people in the room. Some people made some money, some people lost some money, and some people have put a question mark against it, and they'll tell us in a couple of weeks what's happened, actually. We've got a great panel here, people from across the globe, so touching each major financial center, and they'll tell us a little bit about themselves. We'll start off with Shane, if you could do a little introduction about yourself, what you do, where you're from.
Sure. My name is Shane Braunstein. I'm the Managing Director of Asia Pacific for Gain Capital. I'm actually subbing in today for our CEO, Glenn Stevens, whose flight was delayed about 2 days due to the snowstorm in New York City. So Gain Capital has regulated entities in Japan, Hong Kong, Australia, and Singapore, and a presence throughout the region. And so, I think to let the cat out of the bag right away, we were not materially adversely affected by the events, and so we can talk more about that as the panel proceeds.
Perfect, thank you. Over to Dennis. Oh.
Hi, my name is Denis Sukhotin. I'm the chairman of the iFX Pro.
Just 1 minute, I will just let them finish the... I'll just translate that for you in 1 second. Yeah, please, Dennis.
Yep. As I said, my name is...
Come again?
She finished? No, she's not. Right. Okay, so I'm representing the iFX Pro here. I'm in substitution of my CEO. He's just staying in Cyprus because we have a lot of work with onboarding the new clients from the brokers who is not with us today, unfortunately. As FX Pro, we're running the global operations from our 2 offices in London and Cyprus. We're under the regulation of 2 regulators, FSA and CySEC. We've been affected by the Swiss franc. We lost some money on it, but we'll talk later how it works. But the company is well capitalized and nothing is happening. We are working as usually. Thank you.
Yeah, Matt.
Yeah. Hello, my name is Matteo Legler. I'm the CEO of ADS Securities. We're based in Abu Dhabi, licensed in London, FCA, Hong Kong. We cover retail and institutional clients across the world. We have been fairly untouched by the event with the S&B, well prepared for it, and look forward to discuss it. Thank you.
Just 1 second. We do have some seats in the front, please. So if you'd like to come forward, everyone in the back, we've got a lot of seats in the front. Thomas, over to you.
Hello, my name's Thomas Coughlin. I'm the CEO of Bullion Capital. We are an exchange for physical spot precious metals. We have 11 different global trading hubs around the world, basically spread across the world, and 4 different office locations in Brisbane in Australia, Shanghai, Bangkok, and also Cyprus, and we're about to open a New York office as well. We're a complete B2B business. We face our brokers and our liquidity providers, and we're really offering a disruptive model, and we've introduced this into the precious metal space, the physical precious metal space. Our business is non-leveraged, one-to-one, largely a longer-term investment solution, so we weren't affected by the SMB crisis. at all, really. We offer that stability to our market participants. So thank you.
Thanks. Mohsin?
Good morning, everyone. My name is Mohsin Jameel. I'm the founder CEO of Trade Next Limited. We are an FCA-regulated firm based in London, and we offer retail and institutional investors to trade on the FX and CFDs. We recently launched our liquidity arm, which is Trade Next Prime. We were quite lucky. We have nearly escaped from the impact of the SNB. So, yeah.
Oh, thank you. Adam, last but not least.
Last but not least, thank you. Yes, my name's Adam Reynolds. I'm the CEO for Asia Pacific for the Saxo Bank Group. Saxo Bank is a Danish bank which is regulated under the European Banking Authority regulations by the Danish FSA. And as such, as a bank, we have very strong capital requirements. So whilst we were impacted by potential losses if clients don't pay back their negative equity, those potential losses, even if they are all realised, has not significantly changed our capital position from where it was as at June last year. And that's an announcement we made to the Irish Stock Exchange at the end of last week. And we believe that the strong capital position that we have puts us in a very strong place to continue to grow our business going forward as the impacts of the Swiss crisis ripple through the industry.
Thank you. Well-rehearsed answer. No, I'm joking. Let's go back to the 14th of January. I think everybody was quite happy, smiling. They probably didn't even know what the peg or the floor was. Shane, do you want to talk us through actually what happened, the events that happened on the 15th of January around the Swiss franc, the Euro Swiss, and the 120 mark?
Sure. Wasn't expecting that question. In essence, the Swiss National Bank had been enforcing a floor of 1.2 against the euro to prevent the disadvantageous appreciation of the Swiss franc. They decided that policy was going to not continue, and obviously when that news broke, it caused enormous disruption in the foreign exchange markets. There was very little liquidity in Swiss franc pairs, specifically in the Euro Swiss pair, which I think market participants were candidly uncertain how to price. From Gain Capital's perspective, what happened? I think Gain Capital had identified the Euro Swiss floor as what we would call an asymmetric risk many months in advance. So actually, we had raised margin requirements on all of our traders to 5% around the globe, irrespective of the regulated entity in question. So Gain Capital, Gain Capital's traders and clients were much better capitalized, I think, than some other parties' clients who often had leverage of, say, 200 times or 400 times. So Gain Capital had also, because this had been identified as an asymmetric risk, Gain Capital had also taken out multiple hedges. So there was a multifaceted hedging strategy that involved, yes, cash hedges with LPs, but also options. And as such, we were able to avoid any really adverse effect from the event. Now, with that being said, some of our clients did have that trade on. Some of our clients did, lose more than the amount of equity in their accounts, and Gain Capital has stepped up and actually credited those accounts and forgiven the negative equity that those clients accrued on that day. With that being said, I think what happened on that day definitely came as a shock to many, but I think our risk management committee, which has industry professionals who've been doing FX trading for 60 plus years between them, had identified this risk well in advance and taken steps to mitigate it. I think this setting, to be candid, is an interesting place for this discussion because, we're in Hong Kong, and Hong Kong may be home to a currency peg. It's interesting. I think that was a risk actually that Gain Capital has identified years ago, and our customers sometimes complain about it. Oh, I can't trade Hong Kong dollar on 200 times leverage. I can't trade Hong Kong dollar on 100 times leverage. We lowered leverage on Hong Kong dollar to 10, meaning 10% margin requirements in 2010, I believe, across our regulated entities. And so I think this is a great forum in which to discuss the Swiss National Bank event.
So what's your forecast on the Hong Kong dollar then?
I don't have one.
Yeah. All right. Oh, Dennis, tell us about the actual experience. So were you in the office when this disaster happened, or did you get a phone call? Were you on a plane?
All right. I got a phone call, then I went on a plane, and then I've been in the office.
Yeah,
That's
okay.
how the events was. All right. In fact, I shouldn't say that it was very unpredicted what happened. It was quite predicted, and we had a guess that that may happen in a day. Okay, it's happened unexpectedly in the midday, and I would say that in the middle of the week. And I would say that the way the Swiss Central Bank executed that was a weird thing, and in reality they could do it in a better manner. There is different scenarios how that could be done, not to shock the market up to that level, but still, what happened, that happened. Okay, we had a course, immediately when it's happened, we had a course in action, what need to be done. So first we started discussing with the banks the execution price of a lot of the trades which been triggered out by the margin calls. So that was the first thing. Then we had our dealing, raising the negative balances. So we forgive all the negative balances, and we believe that should be part of discussion in the industry. If the brokers have to protect the clients from negative balances or not. I'm supporting that 100% the brokers have to protect their clients from negative balances, and we're standing in it. We are promising for our clients the 100% protection from negative balances, and that I believe is the right thing, because they are not eligible counterparties. They are private clients, so they can't really evaluate the risk. We have to do it as a brokers. We have to take the responsibility for the leverage, for the risk we're giving.
But is that what does your bank allow you? Do they wipe off your negative balance?
Not of course.
So then why should the
not.
clients?
Yes, but I'm a legal counterparty. I'm the businessman. I know what I'm doing. We're a financial company, right? So we should have our own risk management. The banks should have their own risk management, but the client really cannot evaluate that risk.
Clients have a stop loss. They have
yes, they have a stop loss. Yes, they have the tool. They have a stop loss. But what happened? Because there was no liquidity for a few seconds, and the drop of the price was so sudden, the stop losses was triggered. But then the execution happened really at much lower prices, and that's what the clients cannot predict. And then I believe it's very unfair to call the client and tell him, look, okay, you lost 20,000, you owe me another 200,000, so what assets you have to sell for sell? That's...
But this is the beauty of leverage trading. It happens in other products as well. When people sign up to the terms of business, they appreciate that, and your risk warning says you can lose more than your initial deposit. So,
in fact, we are saying that we're protecting the clients from the negative balance. Yeah. That's what is our terms and conditions, and I believe that should be a normal of the industry.
Fair point. Any of the other panelists agree that it should be a practice across the board? I disagree personally.
I'm more than willing to probably take that question up, and I obviously fundamentally disagree with that viewpoint. My view and our view as a bank and as a regulated bank, firstly, is we couldn't forgive the negative balances even if we wanted to, because our regulators would not allow it. But I think that as an investor, you want a bank or a financial institution that is going to be safe, that is going to be liquid, that's going to have a strong capital position, and that is not going to be holding a whole lot of risk on its books. If you're a broker who turns around and chooses to implicitly or explicitly forgive negative balances, then all of your clients' risk is your risk beyond the margin amount that you have. So if you're offering margin of 100 to 1 or even 50 to 1 and you get a move of more than 1 or 2%, then all of that risk is your own risk, and the investors who invest in you or invest through you and whose capital you have is at risk as well. So we fundamentally believe that forgiving negative balances increases the risk on the broker and makes the capital position of that broker much weaker.
Okay. Any other panelists agree or disagree with Dennis?
I tend to agree with Dennis that the negative balances shouldn't be forgiven because it goes against the principles really of, from a I guess a private investor point of view, those actual principles. I mean, these events happen. And I think that investors and also brokers should expect the unexpected. These events, these black swan events have always happened. Whether you look at market news rolling out during the financial crisis, whether you look at events like 9/11, the market gaps, and the market gaps can gap for you or against you. And I also agree with Dennis that, sorry.
Shane. No, Dennis? Yeah.
Sorry.
Adam.
Sorry, I agree with Adam. Apologies. I agree with Adam that that the organisation, the institution, the bank that you're dealing with should actually be well capitalised. I would go further to say, and Saxo Bank have obviously done this, in attracting longer-term investment products within their mix. This brings on, obviously, additional collaterals that can be cross-margined and collateralised against short-term trading funds. I believe that there's the online broking space is obviously filled with participants that are targeting short-term trading funds of investors, but not longer-term trading funds. Those longer-term and trading funds, there's obviously a large pool out there, and they can be collateralised and cross-margined. And if those brokers were actually attracting those additional collaterals, then we wouldn't be seeing the same sort of losses and negative client balances that we're seeing today.
Talking about negative balances, are there any other instances in normal trading where people can get into negative balances?
Excuse me, can I just add, a few things? I
Oh,
do
go on.
agree with you that the companies has to be very well capitalized in order to survive any kind of the crisis or anything happening in the market, as we've been, as your company is being capitalized. But should add that the European regulators probably have to increase the minimum capital for the brokerage firm. Because today it's really low. It's like €1 million, and you can get a brokerage license for the market for the market maker. That, in my opinion, is unacceptable because the risk the companies has is much above that $1 million. So I think we should move more to your American model, where is it 30 million the minimum, right? 20. Okay, 20 million plus the capital adequacy, and they should have them. That money should be in cash as a cushion, correct? So I think that's where the European regulation has to come. But I will still disagree with the protection of the private clients from the negative balances. You should protect them from that because that's practically what for they're paying you. They're paying you to provide the services. And then you cannot put that risk for the private individuals because it's significantly higher than their risk capital. Because look, the people who is trading with us, they are not putting the investment capital, they are putting the risk capital, the money they are ready to risk, right? So if they're putting the risk capital, we cannot put them in a position that could be 10 times more. The risk could be 5 times more. And then
That's fair enough, but like I was saying, these events are going to keep on happening. So then you have to look at leverage because
you have to look at leverage and at risk. You should have your risk
Certainly.
committee deciding on a leverage on a different products. I do agree with that, and you should have
If I
the
could just-
capital enough to survive.
If I could pause you, gentlemen, and get Matt in, because we'll have a...
No, I certainly think the capitalization is extremely important. We are extremely well capitalized. It allows us to navigate extremely well, keep on very liquid line with all the PBs. On the negative balance, I think you might have other measure, maybe guaranteed stop you can propose to the clients to achieve the same purpose. But as a general rules, I tend to be also against it across the board. And regarding the regulation, most probably you will have secondary effects that will impact and take certain decisions. But the capabilities of a company to risk manage, use his platform, IT infrastructure, should be there and should be used so to provide certain leverage to the client in admissible parameters. And not everywhere you're authorized to forgive the client's balance. It has severe consequences.
Shane, with the negative balances, what kind of message do you give to the marketplace if you do remove or forgive, as you guys are mentioning, forgive the negative balances?
I guess.
How does that tell
Yeah.
tell the end user about your risk models?
Well, what I would say is, I think it's on a case-by-case basis, and that making, forgiving negative balances kind of as a rule, is not a great thing for the industry. I do think that in this particular case, I think it's viewed as a black swan event. It's viewed as, in many ways, a misstep by the Swiss National Bank. And so, I guess to me, it's a question also of the risk management, because forgiving negative balances is something that you can do if your clients are adequately margined or are sufficiently margined where their exposure is limited. And so, again, I think a lot of brokers were offering literally 10 times the amount of leverage that Gain Capital was offering on this product. Therefore, the exposure was massive for them. I do think in terms of negative balance forgiveness, I do worry about there's the 2015 effect, which is what do our financials look like if we chase after clients' negative balances? And there's the 2017 effect, which is what does the industry look like after there's litigation in the news, after after retail clients have, to Dennis's point, lost significantly more than the risk capital that they had placed in the account. That's my concern, is from an industry perspective, where does this land us in 2 years, 3 years, 5 years? So I guess that's my perspective on it.
Could it be a repeat event then? Do you think, Dennis, will you always be forgiving negative balances?
I'm sure that we are coming to the era of the very high volatility. I'm sure that we'll have the currency wars between the countries. Yes, we are expecting that some kind of the events, maybe similar, I think in a less scale, will happen. We'll definitely have the gaps opening or something. But we will protect the clients from negative balances, and that's a matter of reducing the leverage on the certain instruments. Like, for example, USD ruble, we reduce the leverage to 10 at a certain point of time, then we increase it back. Because when it was high volatility and the ruble was opening with the gaps every morning. So that's a case-by-case thing. It's case-by-case, currency by currency. So we have to really, we have to change the leverage and the maximum exposure on each currency for ourselves.
Sure. Mohsin, what's your...
Yeah, Adil, I want to add something to it. Look, we haven't experienced that thing, because we are a fairly new firm. But fundamentally, I would agree with Adam that, we cannot actually, it depends on the appetite of the firm. If you are heavily capitalized, for example, there are many firms who has actually ignored the negative balance. But if you're not heavily capitalized, and if you're a startup firm, then the thing is, you still have to go back to the client and chase them for the negative balances. And fundamentally, we have to, because we are giving, many firms are giving high leverage to the client. So that means they have to return the money back to the firm. So I believe that we have to get the negative balance back from the client.
Sure. Will FX firms now have their own capital requirements for the regulators and then a separate pot for these negative balance? How does that justify being in this business?
Well, Adil, to add, I will say that regulators have become really proactive in their approach now. So they will make sure that all the FCA regulated firm should have enough capital in place from this incident. So I don't think so that we should have a separate capital for the negative balances and a separate capital for the firm to run. It's all about how we are managing their risk. That's why I can say, yeah.
Adam?
I think just to add to that a little bit, on the prospects going forward because of this, I think that the regulatory activity that everyone has witnessed since the event will continue on for some time. And I think the regulators in those countries that don't have limits on leverage will probably start to look to introduce it. Certainly, for Saxo as an institution, we have offices here in Hong Kong and Singapore and Australia and Japan, which 2 of them do have caps on leverage and 2 of them don't. And it's quite clear to us that the caps on leverage have been quite successful in terms of protecting the clients in the countries where they exist. Similar to our friends at Gain, we also increased the margin from 4% to 8% on all Swiss franc products around September, October last year. So that insulated us and insulated our clients to a large extent, and so we witnessed a lot of clients moving positions in Swiss away from us to other competitors. So in a sense, we had preempted that, but I do think that the likelihood is that the regulatory reaction in a lot of the financial centres will be to introduce more caps on leverage.
And I think regulator will also probably come forward with some sort of policies on the leverage. You never know, they might put a cap on the leverage just to mitigate the risk.
Perfect. I'm going to take us back a few years. The flash crash, was anyone affected by the flash crash? Were there any negative balances there? Anyone in the audience? No. All right. So we'll move on from that. We'll move on to another question now. We want to ask sort of all the participants how they were actually affected. We've got all the data coming into our news site. But Adam, are you able to tell us how many sort of, we've spoken about the loss side. How many clients profited from this, if you had any?
Yeah, we had clients on both sides of it. I obviously can't give the numbers of clients that were involved, but
Can you give us a range or a percentage just to gauge the atmosphere?
I'd say that it's a de minimis number of clients that were involved in Asia Pacific.
Minimalist, is that your figure?
A small number.
Sorry, figure. Oh.
A small number of clients were involved in Asia as a group, on both sides.
And what kind of clients? Would this be the retail, sort of more institutional funds?
A mixture of retail and institutional, but most of the retail clients that were involved were people who work in the financial industry.
Okay.
The places where people are more retail and less knowledgeable about the financial industry actually were not that interested in the Swiss franc. So it's a lot of people who are working at banks and other brokers and fund managers who are involved from our point of view. But as I said, because we had increased the margin from 4% to 8%, we had significantly less positions than we would have had if this had happened 6 months earlier.
What's the firm's outlook on the loss? I know you tried to protect yourself with reducing the leverage, but this actual figure that you've displayed, is that something that you had expected, or is that something you had worked out previously?
Well, we obviously, as part of our day-to-day risk management, we do stress tests on our portfolio as a whole, and those stress tests are what we had looked at, which is why we had increased our margin requirements, because the stress tests were showing to us that we had a growing exposure in the Swiss franc. So we thought the prudent thing to do was to increase those margins. So I guess that's probably, from a foresight point of view, that's what we think is a prudent thing to do.
Just 1 second.
Thank you.
Okay.
It's coming in Chinese in a moment, I think.
Sure. So we'll be going around. Mohsin, if you can tell us the exact figures, please.
Well, Adil, we have a very few negative balances. I mean, we have got clients who have got very few negative balances.
And profits?
We don't have, we don't have client who has made profit in the book. We have made profit though in the book when this happened. And I think the reason that we have got a very few negative balances because we have got a very robust risk management team in-house, and we offer very less leverage. So we make sure that, our risk is mitigated. We do a lot of stress testing on a day-to-day basis, because the reason we are a new participant in the market, so we have to make sure that we are not, overselling to the client, and the repercussion will be like this. We'll be wiped out completely. So, yeah, on that ground, we were safe, to be honest. Yeah.
Thomas, should we pass you? Yeah?
Like 1-for-1, no leverage.
Yeah, sure. Matt?
Well, similarly, we had increased margin to 10% mid-November, which was pre an important vote in Switzerland, and kept it so we had little client exposure on CHF. 95% of the ones that had trades were on the wrong direction.
So you benefited overall. Was it a net positive?
Slightly positive.
Slightly. How many millions is that slight?
A couple.
A couple. Okay, thank you. Dennis?
We had some losses on that day. So when that's happened, We immediately had the FCA and SISEC in our offices in London and Cyprus. We had PwC in our office in Cyprus. So they made all the calculation, they check clients' balances, they check clients' money, that everything is in place, everything is fine. They check the capital of the company. We have been well capitalized, much above 12%, and after the impact of the event. So, you know, we lost some money. Me as a main shareholder, I took that on myself, but that's about it.
So any raw figures you can share with us? How many zeros? You can see I'm
just
trying
to
get
calculate the
exact,
zeros.
yeah.
Yes. Okay, it's millions.
Yeah.
Right, but that was okay.
Okay, perfect. Not tens of millions. Happy to see that it's not tens.
It's the figure which is going in the media is around 20.
Yeah, I'm only saying that because in Cyprus, there's 24 brokers said they lost 42 million. Out of the 24, we know from our intelligence, there's probably about 4 or 5 that have 80% market share, which you are one of them. So we're trying to sort of use our seismic figures.
You see, we as an agency model, and there is probably another few companies as an agency model, or the companies which was registered in Cyprus was setting the prime of prime, they lost the money. But most of the bucket shops, which is just, you know, market makers, and they have one empty floor, they don't hedge anything, they didn't lose anything, just made money.
Shane?
Sure. So I can give you some concrete figures, but not around financial results. Gain Capital is listed on the New York Stock Exchange, and you know there's very little that I can say in quarter about our financial results. I will say that we were not adversely affected in any way, and in terms of our clients' exposure, a few hundred of our clients, I think, a 3-digit number, were adversely affected by the move. That's out of a base of over 130,000 accounts. So again, I think because we had increased margin requirements, clients who were interested in this trade had taken their business elsewhere, or had margined themselves, you know, with more capital.
Perfect. I know earlier in our pre-brief, Dennis was saying that there was an alternative that the SNB, the Swiss Central Bank, could have done. Do you want to talk a little bit about that? The event happened, I think it was a Thursday, about 9:30 UK time, I remember. So what else could have happened? And we also have a Swiss national on this panel, if you haven't guessed who it is. It's the gentleman on the far left. No, sorry, it's the middle chap here. And he's also going to be defending his friend, Mr. Jordan. Yeah?
We're not friends.
No, you're not friends. You were friends.
That's good.
Yeah, Dennis, what's your alternative theory?
All right. I have few theories how that could be done. Okay, if they should do it immediately, they could wait until Friday, the markets, but they're going to be closed, so do it announcement on Saturday, so the people have at least one day to think what's going to happen. And especially the banks and the other liquidity providers to allocate their trades accordingly. Because, you know, it was obvious that the price is not right, but then you can make a calculation and come to the opinion, okay, it should be a 1-to-1, it should be a 110 or something. Okay, that's one scenario, which is very simple. And the second scenario is they could do it gradually. They can decrease the interest rate, which they did, then to say, okay, we're going to move the floor to 119, or we're thinking to move that floor away in a period of time, and then the people would understand, okay, the floor will be moved, the price not going to go up, there is no need, you know, they'll need to trade, so they're going to start closing their positions. So that's my opinion.
Sure. How's this theory for the audience? Any agreeers, disagreeers? It's quite a rather quiet audience today. Any takers? We have mics if you want to speak up. Go on, Ed. We have one agree. Any more agrees? Let's have hands. I agree with the theory. Good, we got 3 agreeers. 3 from FX Pro, me, and... all right, any challenges to this theory? Adam?
I certainly agree that it would have been more convenient for the industry as a whole if they'd done it on a weekend.
You play golf on the weekend, so that would have...
My golf is definitely not worth playing on the weekend, I can tell you that. But I think there's also challenges with doing it on a weekend. Certainly our friends in New Zealand would be very happy because they would have a lot of turnover on a Monday morning. But yeah, the market opens at 5 a.m. Sydney time, 7 a.m. New Zealand time on a Monday morning, and dealing with that sort of liquidity in an early market then, it's probably going to be more challenging than dealing with it during the liquidous part of the day, which is probably around that time, 9:30, 10:30 on a London morning. They are the most liquid markets. So I think it would be equal challenges doing it on a weekend, but maybe the industry does have a little bit more time to prepare. I think to the point of doing it gradually, I think moving it from 120 to 119 would just invite a lot more speculation immediately. And so the growth of the reserves of the Swiss National Bank, which have been growing steadily, would be explosive, and they'd have to move very, very quickly again. So I don't know if doing it gradually is a successful strategy. That's been tried by other central banks in the past. Maybe if they moved it from 120 to 110 in one hit, that may be more helpful, but either way, if it's going to move from 120 to 110, you're still going to think that they're going to do it again, and you're going to invite a lot of speculation and a huge growth in reserves.
What about, I think, did the IMF senior person say that they could have consulted us?
Yes, Christine Lagarde. Yes, she was seemed a little miffed that she hadn't been consulted in advance, and
So,
I guess that's politics.
Do central banks have a duty to do that? Should they be in discussions? Is for such an impact on the global market?
Maybe
I
Matt
don't
can
think
answer that.
on such an event you can afford to really communicate. You're counting on the event to be unexpected. Else you have a lot of investor hedge funds that will play it. And also the way the floor on the Euro Swiss was made in 2011, it was for a purpose, and it just became unsustainable for the Swiss Central Bank to keep it. So once you take the decision, or you reach the conclusion that you can't afford to keep it anymore, it has to be done in such a way. Regarding the timing, whether it's a weekend, I think you have pros and cons on different situations. But ultimately, it's better if you can ensure that you have as many people as possible around the trading floor to be able to act on it, because it is a big event. Now, I don't think it will occur many times in the future. Not all the other pegs that you have in the world are done in the same purpose. In Swiss, it happened in a very specific environment. It was post-financial crisis. You had the Swiss francs that was taken as a reserve currency, safe haven, a lot of inflows impacting the economy, and that was why the measure was initially taken. It was the best decision at that time, not so sure, but it was clearly unsustainable.
Shane, would you like to add anything?
No, I would echo Adam's sentiment that I think the timing is in question. What would be the best for the market, but a gradual approach would definitely invite speculation on a massive scale that the Swiss National Bank could not see through. So I think that tearing the Band-Aid off was the only way to do this, to be colloquial about it. But the question is, would you do it on a weekend and then give the market time to staff up at 5 p.m. Eastern in New York on Sunday, or would you make the announcement when everyone's at their desks 9:30 a.m. in the morning in London? So, it's not obvious what the right answer is, but I think a gradual approach would be out of the question.
As people who run a leveraged business, what's your individual thoughts now of this sort of sector that you're in? Has it given you a bit of, have you burnt your fingers in a way? Have you become a bit nervous? Are you going to be questioning your roles and the way the business is going to be moving forward from an individual perspective as opposed to industry? How has it impacted you, Dennis?
You see, the margin levels and the volatility, that's what you always have to evaluate. When there is a low volatility, you can use a higher margin. When there's a higher volatility, you have to use a lower margin, and you have to be well capitalized, both as a trader or as the company. I don't think, for me personally, nothing is changing. Life keep going on. Everything is running. So, and as a trader,
Wasn't it a panic or scare for you? I mean, you could see obviously that you are losing money, and you didn't know actually what was going to happen in the next hour or two as well.
it was very fast. It was 3-7 seconds. So you don't need an hour.
Just the ongoing impact. So the banks had widened their prices. We didn't know actually what figure they were going to clear trades and settle on.
No, for me, it was very obvious that, okay, they will widen the price, they will decrease the leverages, but that's temporary measurements. Everything will come back to normality very soon. So I don't think anything changing.
Perfect. Shane?
Yeah, I mean, I think personally speaking, or speaking for Gain Capital, I think this represents a strategic opportunity for us. We're a very acquisitive company. We've closed 5 deals in the last couple years, including GFT, and then we've announced the acquisition of City Index, which will close in the coming months. So,
Is there any more that you'd want to tell us about?
there are no names that I can talk about today. But what I would say is we're an acquisitive company. You know, we grow both through organic means as well as acquisitions, and we are always in conversations to grow the business. And those conversations, I would say, have been accelerated and proliferated by this event. So for us, it represents a strategic opportunity because we are financially sound, because we do have an appetite to grow, and we do have strong base of capital. So for us, it's an exciting time.
Matt, your firm is well capitalized. We've heard that in the news several times. But as a business, then, does it make sense? Are you going to get the ROI that you intend, looking at this event and the nature of this business?
Well, we see many opportunities. We really looked at different potential transactions. We always prefer to grow organically, and I think we'll continue. Now there is a lot of opportunities in the market to find experienced and talented team to expand our offices in London and Hong Kong.
And when are you opening your Swiss office?
There is no plan for a Swiss office. But no, we're really looking to increase the headcounts in the UK. We doubled the capital in London to be able to grow on it. In Hong Kong also we have different discussions. So things look very interesting. We can build on the technology and the platform we have built. Everything proved to be extremely robust during the event, worked very well. Risk management was also a key part on how we handled the situation. The speed at which you need to be able to assess the situation, how to best execute your client's order. Everything is important, and clearly the fact that the current environment is supportive for companies that have strong financial and excess liquidity to be able to play around as the event will unfold. I think it's not completely finished. You might have some other ripple effects coming in the coming weeks or months.
Tom, what did you get for your second Christmas present on the 15th of Jan? Because it must be all good for you talking about the anti-leverage flag, yeah?
Yeah, I mean, it was obviously good for us, and we had a gain in the gold price because of the instability in the markets. But, I mean, what I think for the industry is that they should constructively, I guess, learn from this event and look to diversify their businesses as well. Obviously, the online broking industry is really quite, I guess, targeted towards the short-term trading space. They can easily expand their horizons into longer-term investment products. There's vastly more wealth held in longer-term investments, and there's no reason why online brokers in the CFD or FX space can't target longer-term investments, bring that within their universe, increase their funds under management, and increase their collaterals that they can offer cross-margining to their clients on. So I know there's obviously, there's great profit margins in short-term trading, but if online brokers were look to diversify their businesses, then they're just improving the longevity of their businesses and bringing stability and sustainability to their businesses. So obviously we're in Asia at the moment. I mean, talking about what we do, there's 25 to 30% of family wealth held in physical precious metals. So we offer obviously a solution that can be quickly rolled out by online brokers to capture vast amounts of wealth throughout the region, long-term investment wealth, and that can be utilised for cross-margining purposes. So I think the industry should sort of look at this and really look to expand and diversify their businesses. Because different business lines, different business segments are going to encounter problems at various different points in time, and diversification is really the key.
So do you see this as an alternative? Do any of the other panelists want to sign up to Tom's products?
Well, I'll talk to you afterwards. But no, I think diversification is critical, absolutely. And if, speaking for Gain Capital, I think diversification in our exposures, our clients are trading a huge swath of products, more than 12,000 products. Therefore, our exposure to, this particular single currency pair was relatively modest. So I do agree overall with the sentiment. I don't know if we're signing up for one-to-one bullion, but I do agree that a diversification is critical to financial stability for brokers in this space.
And Mohsin, as a new entrant, is this something that you're going to carry, or you'll go back to the restaurant business? Joking.
Well, Adil, I think this is certainly an eye-opener for us as well, because we are a new entrant in the market. And I think the first thing is, I'm seriously going to take the risk warning, losses can exceed your initial deposit very seriously, because this is what happened actually. So at this
if you
stage,
have an account with FX Pro, so
Yeah.
that might be an alternative.
For sure. So I think what we are doing as a new firm, we are, we have learned a lot from the whole incidents. We are reviewing our whole policies and procedures. As I said, we are doing, reverse stress tests to see where we are in terms of the risk. These sort of financial storm will keep on coming. And a firm like us, there are many big firms sitting out here. They are hit by the whole incidents. Imagine we are a very small entrant in the market. We would have actually gone out completely. The thing is, we have to review all this stuff, and we have to come up with a very robust policies for the future. So especially we're working more on the leverage side and cross-margining, looking diversification of the assets at the same time as well.
Adam, I've forgotten the question, by the way.
That's okay. I remember.
You remember?
I'm so far at the end of the queue, it takes 20 minutes to get to me. I guess, from the Saxo point of view, we are very much multi-asset already. We have cash equities, we have bonds, we have CFDs, we have futures, we have options, we have FX as well. So our platform is multi-product and it's all cross-collateralized and cross-margin. So I 100% agree with what Tom says about diversifying. And even prior to this event, part of our strategic plans for the business is to continue to grow the equity side of our business. And in fact, when we opened the opening bell on the NASDAQ recently, our CEO, Kim Finney, turned around and talked about our CapEx plans being heavily focused on continuing to expand the equity part of our franchise as well. So we see that as an opportunity. Perhaps more specifically, in the short term, the benefits for us from this crisis are really around clients' perceptions of our capital strength. And as I've mentioned before, we believe that our capital strength is unique in this part of the industry, being a regulated bank with a high capital requirement. And we are seeing an amazing number of new accounts come to us both in the retail and the institutional space. So we've probably got 13 or 14 people here actively working, and we're seeing good opportunities.
Adil, you have 10 minutes.
I am hungry. So any questions, please, audience, let's have some questions. We've got this gentleman on the far right. If you could tell us your name and company. Oh my.
William Berkshire, Agora Partners, based in Hong Kong. I'm a bit of an industry outsider from the derivatives exchange space, but this industry looks like an utter mess. The leverage defies logic, and now the idea of guaranteeing losses is utterly irresponsible. It's probably a question that's a bit like turkeys voting for Christmas. But is it not time to move, or to have the regulators to compel the market to move to an exchange model which has proven itself extremely viable in the times of stress, with independent risk management, not risk management driven by sales factors, which is effectively regulated and which pools liquidity? Thank you.
Okay, I'll have a shot at an answer of that. I think that in the light of the global financial crisis, there's been a strong move, especially in the US, to move trading onto regulated exchanges. And I think that that push is going to continue. But I think that there are difficulties in certain parts of the industry with doing that, which is why they haven't successfully moved FX in general onto exchanges. So I think that there is definitely a desire from politicians and regulators to do that, but I think that the challenges around it at the moment are making it difficult for that to occur. I mean, for us, a lot of our futures and options and equities is traded on listed exchanges, there is definitely benefits from having things on listed exchanges as well.
Yeah, sure. I guess I would argue that I think that there are financial instruments that are on exchange, such as options, right, which are available to investors, and that there are discrete benefits, pros and cons, right, to an exchange model versus an over-the-counter model, and that the competition in the over-the-counter space has actually resulted in tremendous benefits for consumers of OTC derivatives over the last decade, in terms of their ability to trade new products and really to get into markets and get into markets and get exposure to financial instruments that were exclusively the province of banks if we go back 10 or 15 or 20 years. So I think that there are certainly merits to each model, but I think that to Adam's point, there will be appetite for an on-exchange model, but that will hurt consumers or hurt investors in some ways as well.
Hi, I'm just curious to get your thoughts on how you think the investment banks have sort of handled the liquidity issues that have come out of the Swiss franc, especially in terms of disclosed versus non-disclosed liquidity. Do you think we'll see more hedging go on to sort of non-disclosed venues as opposed to disclosed, where the trades can be altered days after?
I'm not sure I fully understood all the question.
Yeah, I'll repeat it. So, obviously after the Swiss franc peg broke, there was a lot of requoting by banks. In light of that, do you think we'll see more, agency brokers as well as retail brokers move toward hedging into, futures, into undisclosed venues like EBS, Reuters, and then less, bilateral trading as a result of this?
I think you should have several measures in place to hedge yourself. One part or something we use as a strategy to hedge was through derivatives and options. So it proved to work effectively.
Well, just to add to it, we as a retail broker, we're not going to keep all our eggs in one basket, definitely. We have to hedge a position in different venues. So options is one of the places that we will be looking to hedge positions. Future will be another option where we'll be looking to hedge the position. So we will diversify our risk as well at the same time.
Yeah, I would add that I think the response from banks has been uneven, to be candid. Certain banks have not covered themselves in glory here in terms of requoting. And that, to me, the FX market, the OTC markets, police themselves in a lot of ways, where actions that are irresponsible or uncommercial wind up negatively affecting business. And so I don't think there's been a uniform response from the banks, but I also don't think that bilateral trading is going anywhere. And I think that certain banks who have performed well through the event will reap commercial rewards as a result.
I tend to agree with you.
All right, thank you. So we're just going to get some closing comments from the panelists. We'll start off with Adam right at the far end. So let us know, forecasts, expectations, the next black swan, and anything that you want.
Sure. I guess sort of for me, my thoughts on the three biggest takeaways from this crisis and the impact they'll likely have on the business going forward. Firstly, as I mentioned earlier, I think the increased regulatory activity will continue, and limits on leverage will become more widespread, and possibly a push towards more exchange traded will continue. Whether that's successful or not, I'm not sure. After 7 years of that push being ongoing, but still not got the FX market there, that's an interesting question. Secondly, I do believe that the margin and leverage available in the market is going to be reduced. I think that the prime brokers will offer less leverage to the industry in general. And I think that as that happens, that will have to ripple through the industry as well. If you're only receiving 20-to-1 leverage from your prime broker, then offering 200-to-1 leverage is challenging. So I think that that's going to be a fairly large impact. And most importantly, for being here and being a Danish bank as we are, looking at those pegs that are surviving in both Denmark and in Hong Kong is something that the industry needs to look at as far as leverage is concerned. And certainly, the asymmetric risk that Shane mentioned is something that should be keenly on the industry's mind, and certainly is on ours. And finally, once again, the capital position and the risk appetite that your prime broker is taking is something which I think is going to be increasingly focused on, certainly by those other brokers in the industry who need to access the market through a prime broker.
Thank you. Mohsin, your closing comments?
Adil, I think as a new firm, probably we'll be focusing more on maintaining the confidence of our client, because that is the key for us. How we're going to mitigate the risk. This is one thing. Second thing, we'll focus more on the capitalization part as well. And we'll try to work more around our robust framework inside, so that we can get through this side of financial storm whenever it comes back again.
Thank you. Tom?
Yes, I agree that there'll be a focus in the industry, obviously, and by regulators to increase, capital requirements by market participants, and also perhaps a decrease in the leverage ratios of different securities. As I mentioned earlier, I think there should be more of a focus on expanding, the product range and diversifying businesses and diversifying the business of these different operations. I think the benefits are numerous there, and actually bringing additional collaterals into their space, I think would mitigate the consequences and effects of such events, such black swan events as what we've just seen.
I've just had a moment, because I suspect you guys will be saying the same things as those chaps about leverage and capital. What about Interactive Brokers, a US firm who adheres to US principles? They also lost money on the OTC side. How do we explain that?
I think that they disclosed that a huge proportion, something like 80 or 85% of their losses came from 5 clients. So, as we talk about the retail space, to me, when you have 5 clients winding up with hundreds of millions of dollars in exposure, to me that's it feels like those are more institutional profile clients. And that they've also disclosed that I can't recall whether it was the futures options or futures market or the options market, but a huge proportion of those losses were actually not on over-the-counter instruments, as I understood it.
It had an even distribution, I think.
So. But again, I think Interactive Brokers is a very sophisticated brokerage, and they're very well capitalized, like Gain Capital, and they're well equipped to handle it.
Any final thoughts from you guys?
I think one key and common element was the capitalization of the company. It's going to be key in the future. It was important, and it will be extremely important the years to come. On different sides, security for the clients, requirement with LPs to have enough margin to be able to offer competitive terms to the client, technology, where TDS will continue to invest and expand the products available in our platforms. And regarding the industry, you will have most probably some increased leverage margin across the board, and hopefully something we have also been advocating for years. It might have increased spreads on currencies, because one of the differences is that a broker should provide a service and the client should be ready to pay for the service, not only relying on risk revenues that might distort the model.
Right. From my perspective, what is the future of the trading and the future of the FX industry? When it comes to the regulation, I believe the regulators have to very carefully looking on the safety of the clients' funds, because according to the MiFID, they have to be segregated from the company funds, and anyway they are not at any risk they are not at any risk of the company decisions, right? When it comes to the capital, I agree that the capitals, they have to be increased for the companies, and it should be significantly increased from 1 million to 20, 30, maybe 15 million euros to start with. And then when it comes to the leverage, I do believe that this has to be decided by the brokers and the banks between themselves, and the clients, they have a possibility to use any kind of leverage they like. And I don't think the regulator really have a view on it. And the risk, it has to be dependent on the company, on his capital, on the client base, and it has to be decided by the company by itself. When it comes to trading, I think the future of the trading, it's more comes to the algorithmic trading. What I can see from our client base, that the people who using the algorithms, they are 6 times more successful than the ones trading manually. Saying so, I would say that algorithmic trading is a future. First of all, because you can backtest your strategy on a long period of time, you can understand which leverage you may use and which leverage will gonna, create a margin call on a certain volatility. You can backtest your strategy on different volatilities. You can have the different parameters in it. So I believe the future of the trading, of the successful trading, is algorithmic trading, and we are investing a lot in it. We are making the library of algorithms where the people can download them and use them. We are creating the copy matching machines like Super Trader, where we have from one side the strategies which is trading successfully. You can see their performance, and then you can invest in that strategy automatically without making any of your trading decisions. Okay, that's my view on the future.
Perfect. So we've got some interesting closing comments. Leverage is definitely going to be key. I
hope
we'll
my closing comment isn't on Petter fee and interactive brokers. But no, I guess my closing comment is just that, I think this, an event like this represents a test for all of us up here and for the industry as a whole. And I think capitalization does matter, as some of the panelists have alluded to. Capitalization does matter, and risk management protocols do matter. It turns out that acting as a riskless principle, as many parties in our industry do, does not guarantee that you're not carrying risk. And even if you don't think you're carrying market risk, you might be carrying liquidity risk. And so, I think that the risk management protocols in our industry are widely varied, and that my hope is that we'll emerge a stronger industry after this because of the introspection that will be required at a lot of the shops.
I'll rewind that. So it's been an interesting dialogue. I think leverage, capital, algo trading are some key points. Has everyone enjoyed it? Let's have a big round of applause for the panelists then.
Thank you.
Bit louder, come on guys. All right, thank you panelists, thank you audience, everybody's been wonderful. It's lunch now, we've still got some exciting activities at the end of the day. Thanks, Iris.
Thank you
Thank you.
very much, everybody. Thank you to the distinguished panel and to Adil, the moderator. Please make sure to be here again at 3 o'clock, as we will have a panel about what's hot and what's not in FX technology. I'll see you later.